Thank you for joining today's event. It is now my pleasure to turn today's program over to Client Portfolio Manager Punjak Nayak. Please go ahead.
Thank you very much. We're joined today by Lisa Mason, Head of the Global Growth Team and Co-Portfolio Manager of the International Growth Strategy, to talk about the most recent market events. Lisa, thank you so much for joining us. I'll start off with the first question with respect to current market volatility and performance. So the strategy's relative performance has improved as market volatility has picked up. Did you recognize anything earlier in the year that caused you and or the team to make certain changes to the portfolio?
Well, I think, hello, everyone. So one of the things I think we saw fairly early on is that there was problems within China, certainly the center of the coronavirus. So we really had a front row seat to things that were going on there from early January. And those things caused us some concern early on, and I think that that's important. One of the things we know is that healthcare systems in Asia, especially China, are still in development mode, and we had concerns about how this would play out. It seemed to have turned into somewhat of a worst-case scenario, certainly for at least a certain amount of time, a short amount of time, hopefully with a large part of that population and also with the market. So we really saw how that was playing out, how the authorities were reacting. Now the population, we always try to frame things in a way that we understand from previous crises, et cetera. So we turned to the SARS epidemic, and we realized that this was going to be bigger than SARS because, frankly, we have more people that are traveling. More people have passports in China than they did during the SARS period. So domestic and international travel was far larger. And then we started to wonder, well, what would happen if it started coming, outside of China into a theater near us? So with that in mind, we were looking at stocks that we felt had been somewhat fully priced and felt that the market was being relatively complacent with regarding China. So we started trimming names that were oriented toward the Chinese consumer, travel from the Chinese consumer. So we made some trims, which is an integral part of what we do on the team. Trims and adds are always something we feel we can add some value to. So we trimmed Alibaba, we trimmed LVMH, we trimmed Burberry, and we trimmed Shiseido, as we felt again that those weren't really incorporating some of the sort of downside that we saw going on in China.
Great. And so when you look at your spectrum of growth, or as we call them, the buckets of growth, could you just maybe expand on how you think about the portfolio in terms of being able to operate in different market regimes, and maybe giving us just sort of an overview on how you think about portfolio construction across those three different types of growth categories?
Sure. So as you turn to page 3, you can see how we define growth. Again, we've always believed that growth is not a one-size-fits-all term, but different types of growth stocks have different risk characteristics. We always size the riskiest type of growth, which is emerging growth, the smallest. We know in big downdraft markets, those can really go down the most. So we size the riskiest part of growth, the smallest. And the largest part of our growth grouping, as you know, is secular growth. And these are larger companies, established business models, good managements that are very seasoned in crises, and that can use these type of opportunities to take advantage of those situations in terms of either making acquisitions or making some moves potentially with regard to opportunities. So we, frankly, what we've seen in this downturn is, again, those secular growth opportunities, the secular growth bucket rather, has done the job that we're looking for. It's definitely helped us in terms of downside protection, having large cash balances. Many of our stocks, even our emerging growth stocks, are net cash. We think that that's something, again, that's certainly helping in this pretty volatile market. The other thing that I think is important is when you I think we're going to talk about this later, but when you look at some of the types of names that we own in terms of sectors, there are certain stocks that we just simply won't own because we feel that they're either too levered or potentially have some long-term disadvantages. So I guess we can talk about that in the next question.
Great. So getting back to that performance story a little bit on a year-to-date basis, it looks like technology, financials, and when looking at your sector breakouts, the areas which have led to the outperformance has been tech, financials, and then industrial cyclicals, if you will, energy, materials, so on and so forth. Could you expand on a little bit on all of those three areas and what you've done there that's allowed you to outperform the market?
Right. So, with regard to energy and materials, the portfolio does not have energy in the portfolio, and that's certainly been very helpful as we've seen sort of the problems in the oil market with the disagreement with the Saudis and the Russians. So that's been a good thing. Utilities also we have not been invested in historically. We have been re-looking at those names, and certainly they're getting a little bit more interesting today. On the materials side, we do not have any of the base material companies. Frankly, we just felt that at what felt like somewhat the end of an economic cycle that had been going on for a long period of time, those were not the most interesting stocks, frankly, that we could buy for sustainable and durable growth. So we have names that are really more geared into the consumer, like in the flavors and fragrance side, industrial gases, some other types of names that we think are a bit sort of, have some interesting opportunities that are really uncorrelated with macro events. So materials tend to be, and energy too, tends to be more about, macro performance, and that's not really something we felt comfortable looking at sort of with where we were in the cycle. With regard to financials, I think our financial outperformance generally has been our underweight in banks, and that's something that continues today, and an overweight in the exchanges, which have continued to outperform, even though they have been pretty volatile lately, but they've continued to outperform. Our insurance performance is, again, oriented toward where we see sort of scarcity in insurance products and low, and demand that we think can only rise in Asia. So that's, the Asian insurance companies, AIA and Ping An. And we think that those stocks will continue to do well. There will be a rising demand for insurance products, and really there is a sort of a dearth of products there. So we think, those are interesting companies. Those really have held up very well. Ping An also has a technology bend. They are also doing online doctors as well, something called Ping An Healthcare. So a teledoc type of business. Again, this is something certainly in the market today that's doing quite well. With information technology, the portfolio is overweight IT as a growth fund. You would expect that, and it's very much oriented towards sort of the software side and IT services, with a lot of different types of sort of drivers. So with online payments, with Adian, that's something we think will continue to do quite well. On the software side, again, we have sort of big software providers like SAP on the enterprise side, and then we also have some smaller ideas like TeamViewer and Elastic, which we think Elasticsearch, which we think are very interesting ideas in the software side that are growing again from enterprises and other people that are looking to tap into things like big data, searching that data, connectivity, and so on. Great.
The last time I heard that or stress testing come up this many times was many years ago. And I'm sure that you and your team have been looking at the portfolio up and down. How do you think about stress testing, and how are you thinking about the names that you own today, and what would signify to you as a company that is well positioned, well anchored to weather the storm?
Sure. So when I started my career, actually I started in high yield, and sort of, I would say pretty quickly watched the 1987 debt crisis unfold, where the market dropped 22%. I was really hoping that I wouldn't have to witness those sort of things again, but here we are. So stress tests was something we talked about a lot in high yield, and I think that when we look at companies, from the very beginning, before they get in the portfolio, we think about things like risk, stress tests, access to capital, sort of self-generated cash flow, all of those sort of things. So, what we found in high yield is highly levered companies were very ill prepared to withstand a 10% drawdown in revenue. So frankly, when you look at the portfolio today, today and always, one of the things that you'll always see is a very undergeared portfolio. So we really believe in having companies that are very, very well capitalized. If you look at, hold on, let me just get to the slide here, slide number 5, you can see that net debt to total capital is certainly below the EFA benchmark at 15 versus 23. Profitability is higher, margins are higher, returns are higher. So it's not just leverage, it's also things like working capital, demands on working capital that we incorporate into our thinking as well. Many of our companies have excess cash. Many of them have been doing share buybacks. I would expect some of them to maybe cancel those share buybacks and hold on to their cash, but I'm not really worried about that. I think that actually makes some sense. In a market like this, you probably want to stall a little bit on the share buybacks and just sort of keep your powder dry for other opportunities. So we see Adidas, although they haven't said that they will do this, has very high cash positions. They were talking about $5 billion in share buybacks. They've done about $2 billion of that. And we would expect either they continue to do that at much lower levels, or they'll just keep their cash reserves until we get through this. I think one of the things that I'm going to try and be a little encouraging here. We did see this start very early on in China, this coronavirus sort of situation. It is starting to resolve itself there. We are just getting to sort of the teeth of it here in Europe and in the U.S. It will get solved. So we're hoping that this is not going to be very long-lasting, meaning sort of the rest of the year, but it could be a difficult few, let's say, weeks and maybe even months. But frankly, we think we will get through this on the other side. And then again, having the right stocks, to sort of position yourself for the upside is something that we think is important as well.
Great. And a little bit back on sort of the long-term view, your team always looks at DCF models or creates DCF models for all the companies that you own.
Right.
And effectively a 10-year summation of cash flows.
Right.
Given the cash flows for 2020 are likely to be lower than anticipated, of course, how are you thinking about that 1-year shortfall in the context of the overall 10-year DCF?
So one of the things we know with looking at companies from an intrinsic value mindset is it's made up of sort of a 10-year projected cash flow and then sort of a longer terminal value. But frankly, 1 year in the scheme of things is not what really makes the material part of a company's worth. Provided that there isn't some sort of reason that there is, a complete shutdown of the business, those things will pass, and it doesn't really inform sort of the value of the business long term. So what we have to think about, it's not that 1 year of cash flow. How do they manage that 1 year of cash flow? What will they do to their debt, et cetera? That's certainly important. But what we're trying to assess at this point is what's happening with revenues. Will their business change materially going forward from here? How much different are growth rates going to look? Will they be materially different? Is cost of capital, significantly higher today? And so we're thinking about those sort of assessments rather than, one bad year. I mean, the one thing I will say is if you're looking at just multiples, if you have a high multiple stock and earnings are coming down, typically the multiple derating is what can be pretty difficult. But frankly, we think that, yes, near-term earnings are going to be impacted, but frankly, that doesn't and shouldn't change the long-term value of the company.
Great. I'm going to finish off with this one last question. Over the last 2 weeks, what activity have you done or what changes to the portfolio have you made in the last 2 weeks to prepare yourself for what you believe is a back to normalization?
Sure. So we have higher than normal cash positions today. I mean, I referred earlier to some of the trims that we made. We've also, in the market being fairly stressed in terms of banks, not so much that we're worried about the banks that we own, but certainly we've seen rates coming down meaningfully, and now it looks like those rates are going to be lower for much, much longer than we had originally been anticipating. So we do have some banks that we quite like, very good positions within their markets, but we did trim those banks down as well. They had higher multiples, and so we thought it was prudent to trim those, some of our bank stocks as well. So we're sitting with higher cash positions today, and we're developing our wish list of ideas. In addition to stress testing the current ideas that we have, and once we see some sort of stabilization from the credit markets, then you'll see us starting to sort of dip our toe in and start to add to the portfolio. So we're, there are many names that we've been looking at, wanting to add, and frankly thought there really wasn't enough upside. Now we're getting it. So we're just trying to find the right moment where we think things are bottoming, and it's, I don't want to say safe to go into the water, but safer to go into the water. I think the most important thing that we're looking at today are credit markets and how central bankers and governments are really looking at those markets to sort of stabilize and prevent any sort of serious systemic shocks to the market. So, we're pretty sure that people are well focused on that. The other thing I'll say is that the banking system is in pretty good shape. We do have some issues with swap markets and other things that need to be resolved, but I'm fairly confident that those things can be resolved over the next few weeks.
Perfect. Thank you so much for your time, Elisa, and hang in there. Thanks again.
Thank you.
Please note the following. Past performance is no guarantee of future results. The opinions and views expressed in today's call are of the individual speakers as of March 18, 2020, and may differ from other managers or the firm as a whole, and are not intended to be a forecast of future events, a guarantee of future results, or investment advice. Any statistics referenced here have been obtained from sources believed to be reliable, but the accuracy and completeness of this information cannot be guaranteed. Neither ClearBridge Investments nor its information providers are responsible for any damages or losses arising from any use of this information.